My name is Terry Reed. I'm the Financial Literacy Manager for the Knoxville-Knox County Community Action Committee. And today our topic in the continuing Budget in a Box series is payday loans. I am joined today by Don Lorenzo, one of our VITA volunteers, and he will be presenting with me as we help you understand what payday loans are, how they work, and how to get out of the trap of payday loans. So the first thing we want to do is define payday loans for you and tell you what they are. A payday loan is a short-term loan. It lasts anywhere from 2 to 4 weeks. They don't require collateral or a credit check. A payday loan is expected to be repaid in a single payment with your next paycheck. And now a paycheck is any income from any regular source. That can be your job, that can be Social Security, that can be your pension. Now I'll turn it over to Don and he will give you some ideas of how payday loans work and why people get in trouble with them.
So thank you, Terry. As far as how payday loans work, it's really quite simple. You go into the office, you request a loan amount. Now, there are some limits on this. We'll get into those later. And a repayment date, which is typically your next payday, either weekly basis, maybe every 2 weeks, or within a month is typically what the rules are. You then authorize the payday loan company to make an electronic deduction from your bank account, or perhaps you have a debit card for that amount, and then there's going to be fees owed that you pay on that date. Or alternatively, for those of us old school, you write a personal check and they in effect hold the check. And so they're going to cash it at the bank when that's due, but you've already prepaid for them. And then once the paperwork is in place, they hand you the money or deposit it to your account, or again, credit it to some kind of a debit card. The specific state laws are widely varying. So any of you watching this who are not in Tennessee, you need to go look at your specific state laws, and these are not available in all states either. This page you see here is actually from the National Council of State Legislatures. But let me just show you how this works. And by the way, that reference is at the end of this presentation, so you can go to this website yourself. But if you go to that website, it's a very simple search. Let's just, for example, I know we have several listeners down in Florida, so let's just look at the Florida example, and we can see that here's the Florida law. Many of the limits are exactly like Tennessee, a $500 limit on the amount, 31-day loan term, but some of the details are a little different. So again, you really must go to the specific state, what's laws and what's allowed on that. Again, we can't cover every possible state here in this presentation. But for those of us in Tennessee, back to those specific limits, and this is in the Tennessee Code annotated here, but the maximum loan amount is $500. The maximum number of outstanding checks can be 2. The maximum loan term is 31 days, and the finance charges are less than or equal to 15% of that check face amount. Now, be very attentive to that percentage rate, because first glance, that doesn't look horrible. I mean, we talk about credit cards with interest rates of 18% or 22 or 26%. But be careful in that, because there's a trick I'm going to tell you about here in just half a second. But if we look at the payday loan statistics, you find the average loan, again, the maximum is $500. Average loan, of course, would be less than that, and it works out to be about $375 nationally. Typical cost is between $10 and $30 for every $100 borrowed. Okay, 2-week repayment period, and this is where it gets tricky. It's a fee of $15 per $100. If we just take that as that's actually on the low end of the scale, but that's a Tennessee kind of a number. That equates to an annual percentage rate of nearly 400%. What about that 15% business? Well, no, that's 15% per $100 for 2 weeks. And so you can get hit with that fee over and over again 26 times a year. And so when you work the math and try to compare it on what most people have in their head as a interest rate, again, it works out to be almost 400%. And again, I remind you, that's on a cost of only $15 per 100 borrowed. In some states, that number can be as high as $30. That means the interest rate is nearly 800%. So these are incredibly expensive loans. And part of the reason some of you are going to say, well, there's something called usury laws. It's just exorbitant lending rates is what that means. Aren't I protected there? Well, here's the trick. The state law specifically excludes payday loan fees. It says for all other state law purposes, that doesn't count as interest. What do you mean it doesn't count as interest? Well, it's money you're paying. You can call it what you want to, but what I'm telling you is other state law protections you might think you had against exorbitant lending fees are not active. Again, very effective lobbying, the way the law is written, this doesn't count, even though these loan rates are exorbitant. Now, you might say, I really, really need to borrow some money here, and I really, okay, I know it's expensive, but I'm going to do it anyway. If it was only once for 2 weeks, grit your teeth and bear it. But the problem is, when you look at the statistics, 4 out of 5 of those loans are rolled over, and the average borrower ends up in debt for 5 months. So it's not like you're paying this for just a couple of weeks. You're paying these exorbitant interest rates over and over and over again. So some of the folks who can least afford it are paying some of the absolute horrendous maximum loan rates. So, this is a very, very expensive way to get money. And here's what you also look at. Only 16% of borrowers, that's basically 1 in 7 borrowers, is using this for an unexpected expense, like the car broke down and I got to get to work, or the refrigerator went out and I got to keep my food preserved. People are using this routinely for things like groceries and vacations and things like that. And as Terry said, this is like quicksand. It's almost impossible to get out of with these just exorbitant loan rates. Effectively the cost of this loan. I mean, these are I would say should be absolute last on your list of places to get money. And certainly you don't want to be rolling these things over. This is just a terribly expensive way to borrow money. They are available, though, legally in 32 states, about 12 million borrowers annually. And let's, again, look at some typical numbers. Lower income folks, earnings below $40,000 or Social Security or any other pensions, are using this at twice the rate of other people. So again, people who can least afford these kind of exorbitant rates are the more frequent users. People who find themselves in their financial houses getting torn apart because of a divorce, separation, or just never got married, tend to borrow this way at twice the rate of married folks. People renting tend to borrow at twice the rate of homeowners. That's not terribly surprising there, because homeowners would typically be able maybe to get a loan against the value of their home and their mortgage. If you're a renter, though, you don't have an asset to borrow against. People who are disabled or unemployed, and again, people who've lost their income tend to borrow these very expensive loans at twice the rate of people who are employed, who actually have a decent chance at paying it back. And young folks, and this is the most troublesome, is young folks younger than 45, that's over 77% of the folks who are using these loans. So again, these young folks are usually early in their careers, tend not to be in their peak earning years, and yet they're borrowing these horribly expensive loans. And we'll talk in just a few slides about some of the folks involved here. But look at those numbers, $4 billion a year. And you can start to see why so many companies want to get in on a piece of this action. But I'm just telling you, with these steep interest rates and fees, a payday loan is rarely a good idea. And truly, if I think about, when would it be a good idea? Well, if your only alternative was to go down to the local mobster and borrow money from somebody who's going to break your legs if you don't pay them back. I mean, this is a terrible choice as far as borrowing money. So now Terry's going to walk you through some example case studies.
Thank you, Don. I'll just read these case studies to you and just talk to you a little bit about it, and you're going to be astounded by some of these numbers. After her husband was laid off, Paula borrowed $500 from a payday lender, but the Arizona woman found that she could not manage to repay the $588 she owed. That was $500 plus $88 in fees, and that's when it was due in a 2-week time period. She went to a second lender to pay the first and a third to pay the second, getting in deeper until she had 5 loans of $500. She was paying $880 every month in payday fees, never paying down the principal. By June of 2004, she had paid $10,560 in interest. Now, while that is a 2004 example, that is an example of what goes on today. Look at that, $880 in fees, and the principal was never touched, and she had paid $10,560. Payday loans are quicksand that just sucks you down and kills you financially. Now, for our next case study, we'll be looking at Petty Officer Jason. He injured his back and lost his second job as a result of a car accident in July of 2003. He took out a payday loan of $300. Now, remember, he started with just a loan of $300 to buy things for his child. He ended up going to multiple lenders for 7 loans all told to pay the repeated fees on his initial advance and ongoing personal expenses. Now, look what he says. In 5 months, I spent about $7,000 in interest and didn't even pay on the principal of $1,900. Now, again, each state has different rules and different laws. In Tennessee, you can only have 2 of these at one time, and you see where he had 7 loans, but the principal is exactly the same. You can't pay off the payday loan that you've got in the 2 weeks or the 1 month that it's due. So you go to another payday lender to get the money to pay off the first, and you just get deeper and deeper and deeper into the quicksand of debt.
And Terry, let me just add to that. This is a case, the military has recognized how many of our service people are victimized with these loans. And this is a case where the government stepped in, and there's something called the Military Lending Act to protect typically younger individuals, soldiers who might fall into this trap. So there are some additional protections nationally for people in the service to give them some better protection against these, what I would, again, call predatory lending practices.
Another case study. We had 3 deaths in the family and we needed some time off. And on being off, we got behind. That's a normal thing. If people take time off, they're both basically living paycheck to paycheck, and you get behind. So we thought that we needed to get a payday loan so we could catch up. And here's one of the things that happens when you get a payday loan. They don't talk to you about the interest rate because it's not considered interest. They don't talk to you about how much you're going to have to pay back. You think that it's going to be the amount that you borrowed and maybe a fee, but they never talk about interest because in most states that's not counted as interest. They borrowed, and so now they've got $1,100 going toward loan repayment each month. And look at the statement. That was more than rent. You see what happens here? You just continue to get deeper and deeper into the payday loan quicksand.
And another little note on this particular example, note at the bottom, this came from Memphis. As a result of some community action in Memphis, a church, downtown church, and a group called the Hope Credit Union there, they did some investigation. And in the city of Memphis, there are 114, at least at the time, there were 114 different payday loan lenders there. And you might think that's 114 different companies. Well, what they found was 51 of those, roughly half of those, were owned by two companies. They just put up different storefronts. And again, I guess the idea is to get more business, but it's all these different names. You think you're going to different lenders, but you're just really going to the same people. They got the same policies, and there's no advantage to that. But again, it's all advertising and getting this in every community. And like I say, two of these across the street from each other, there's no real competition there. They're owned by the same people in many cases.
I recently went to one of our local strip malls, and in this strip mall, I was sitting there parked and I looked up and there was a loan company. And I watched a lady pull her car up to the side. She went into the loan company, and I'm pretty sure she was making a payment because she wasn't in there very long. And then when she got through with the loan company, on either side of the loan company, there were also payday loan shops. And she went into each one of those payday loan shops. She was either getting new payday loans or she was using money to pay so she had three payments right there, a loan company and two payday loan shops all at one time. That probably took most of the paycheck that she had to pay those loans. Again, that's the problem you get into with these payday loans. They don't have interest, they have fees, and those fees just eat you alive. Here's another case example. My car broke down, so I took out a payday loan for $400. Again, remember the amount, $400. The payoff amount is $567.91. I will not be able to pay that much and still pay my bills. The monthly payment is $170.45, which I also can't afford. The total balance will be $2,045.40. Now, this is from Tampa Bay Times in September the 2nd of 2022. A consumer credit counselor said not to pay it and let it go to collections. And it says, I am worried that they will call my family. Most of the time when you get a payday loan, they also find out nearest family members, excuse me, so they can have some way to get in touch with you. So there's a big embarrassment factor about this. And they will come after you like nobody's business, trying to get a hold of you or to scare people near you to try to get their money collected. And again, the payday loan was $400. What would the total balance of, if you paid it off that instant, be? $2,045.40. Now, Dawn is going to talk to you more about the pitfalls of payday loans and some more about how they work and what you can do.
Thank you, Terry. So again, I think we've emphasized the high cost of this enough, but no consideration of repayment ability. Now, when we talked about another loan practice, which is called buy now, pay later, some of you following our series may recall this. We talked about getting the benefit of the buy now, pay later, like back to school sales. You need to buy clothes for the children, and there's a very real benefit to consumers of the buy now, pay later, as long as you pay it back. So the whole discussion there was, getting all the benefits of buy now, pay later without getting caught into the trap, because there are definitely some traps in that as well, but that was the point of that series. And we're confronting something similar to that with the, the payday loans. Just like buy now, pay later, there's no consideration of repayment ability. It's not going through the credit bureaus or anything like that, which again sets you up to get caught in this trap. Overdrafts can trigger bank fees. Non-payment will trigger debt collection. Terry, in the last example, was talking about calling the family members. Well, in some of those other examples, people stay there. Well, they were worried about going to jail. Terry was mentioning, the threats, the debt collection practices, and so forth. If fraud wasn't involved, jail's probably a bit of an overstatement, but it certainly can put you into bankruptcy. It can certainly, looking here at this last bullet, repossessing items, if say you bought a car, or even losing your home. If they are trying to collect debt against you, or eviction from your apartment if you're not making your rent. So lots of really bad things can happen as these payday loan lenders go to try to collect this debt, which, as you saw in many examples, people have great difficulty repaying because the fees just keep piling up. So as a result of this crisis, there are some alternatives out there. And one of those is something called a PAL, a payday alternative loan. And this is offered through the National Credit Union Administration. It's only offered by some federal chartered credit unions, and each has its own membership requirement. Now, I personally am a credit union member and have been for many years. And so I just simply snipped this from my personal credit union site, but they call theirs a quick loan. But you have to be a member and have had an account open for at least a year, 12 months. You have to have a payroll and some automated deposits. So they got these rules. I won't read them all to you here. Primary owner, in our case, it's the state of Tennessee. But they have some rules. But again, if we look here toward the bottom, the borrowing, the repayment period is not 2 weeks, but 6 months. And the annual percentage rate is 23%. Well, 23% is on the high side, but at the same time, it's a heck of a lot better than 391%. And so it's a much more attractive alternative. You might ask, well, is there a credit union near me or someone like that? Well, yes, there's a tool. Again, this is the National Credit Union, so it's a legit website. And if you go there, you can search for credit unions in your area that might offer these loans. So it's just this simple. And again, this resource is at the end. You put in an address, and here I'm in Knoxville. Terry and I are here in Knoxville. And so these are the ones that it lists. And some of these get fairly far ranging. I mean, 80, 100 miles away, but if you need money, you might be willing to drive. I didn't put any limit in my search. So there's several alternatives here in East Tennessee that do offer these type of loans that someone could consider. But again, this is just a resource for you. According to the National Credit Union rules, maximum percentage rate has to be 28. There's an application fee, $20. You can't roll it over. You can keep over. And the plus side here is if you're borrowing this money and you pay it back on schedule, which of course is what the intent is, now you're helping yourself. You're building a credit history. So you're helping make lower cost loans available to you in the future because you're successfully borrowing and repaying money on the schedule. But as you notice, those PAL loans do say you have to be a credit union member and a member before the crisis, at least a month before applying. In my credit union's case, it was 12 months. They also have come out with a loan they call PAL 2, which is more liberal, but again, it's not offered by all credit unions. And even credit unions like my personal one that offers PAL 1s does not offer a PAL 2, but you may be fortunate enough to live in an area where PAL 2 is available. And the advantage there is that you literally become a member and can take out a loan, and it's a little more liberal repayment periods up to a year, and the amount's a little higher, up to $2,000. But once again, I emphasize, even credit unions that offer PAL 1 do not necessarily offer PAL 2. And again, it's not a requirement of any credit union to open this. It's just an option, and they're trying to serve their communities by offering these lower cost alternatives. When we look at the detailed differences between a payday loan and a payday alternative loan, again, both of them are small dollar loans that don't require collateral. The credit union, the PAL alternative is typically would go a little higher and have a little longer repayment period. Interest rates, though, are much, much more reasonable. Still high, not making any bones about that, but not exorbitant like the payday payday loans. And again, the rollover fees per $100, whereas the credit union, typically there's a maximum no matter how much money you are borrowing. In addition to these payday alternative loans, banks that you would recommend, and I just verified last week that these are still available. Obviously, businesses may change these or may change the exact terms. This is offered here in August, September of 2024. But some banks do offer loans up to $1,000, again, short term. And again, names you would likely recognize, like the Bank of America has something they call a balance assist loan. And it only costs you $5 to take that out. Obviously, you have to repay the loan. Regions Bank has a line of credit that's a 12% loan. Truist, 18%. US Bank, simple loan. Wells Fargo. So again, if you're a member at any of these banks and you do find yourself with a short-term kind of a crisis need for money, these are much better alternatives than going down to the payday loan on the corner, maybe in your neighborhood. If you have a low credit score, there are also organizations you might find online. Now, be careful online because there's a lot of scams out there. There are people just harvesting your financial information. They are not your friends at all. But I don't have personal dealings with these, but these I've seen in other financial magazines that seem to have they're real business. Let's put it this way. They're not just a website somebody threw up there to scam you. Companies like Avant, Lending Point, SoFi. You may have actually seen some advertisements for SoFi. I know I have. Universal Credit, Upgrade, Approva. And again, these would be things to explore about alternate availability of money. Again, these being online banks, they tend to get money to you pretty quickly, and they typically have online forms to get that money to you. They're even, again, if you look around, there's something called peer-to-peer lending. These are other individuals or lending clubs. These are people who say, hey, I'm only getting 3%, 5% interest at my bank or credit union. I'll make loans to people and take the risk. And so there are actually platforms where you are effectively borrowing money from other people. Again, the high interest rates, but nothing like what payday loans charge. Lending Club, Peerform, Prosper, Upstart, some names you might encounter. Some of your employers may offer you a payroll advance loan. you might be a very fortunate person to have that available, but it would be great. You know, some credit cards will allow you a cash advance. Again, those don't tend to be cheap, but cheap in comparison. You may borrow from family and friends. Now, that's one of those things where you get into a lot of emotional baggage when you start borrowing from family and friends. I can just speak personally. My brother got in a situation back in the COVID time. He lost his job. His mortgage was due. You know, you want to help your family member. And so I loaned him some money. And, you know, and I knew he was in a world of hurt. But, you know, he got another job. Things turned around for him, but he wasn't paying anything back to me. And I wasn't even asking for any interest. I just wanted what I'd loaned him back. And I wasn't ever getting paid. So, you know, that's the kind of thing where you start feeling like a chump, that suddenly that, you know, I've helped my sibling out and they're just, you know, ignoring me, not even acknowledging they owed me. So, you know, ultimately it all worked out. But my point is that, you know, when you start borrowing from family, you got to be clear. You need to write that down, and everybody's clear on this. This is not a gift. This really is a loan. I understand. I want to help you out, but you know, you can start feeling like a chunk pretty quick on that. Your church or other community organizations. I mentioned the group down in Memphis. Again, may be alternatives to explore before you get into the claws of these payday loan folks. So Terry's going to talk to you now about, you know, if you do fall into this quicksand, you know, how might you get out of it?
The payday loan cycle is insidious. And what we do wish is that you don't go to the nuclear option, which is bankruptcy. That is an option, but that's not what we want you to do. So I'm going to go over how to escape the payday loan cycle. First, stop automatic debits to your account. Do that immediately. Now, that's not going to make the payday lenders happy, but that's one way to do it, is to stop the debits from your account immediately, because they almost all make you give them a check, a debit card number, something where they can automatically go get the money. Negotiate with the payday lenders and request an extended payment plan. Now, they're not going to advertise or tell you that they do this. You're going to have to be firm with them and say, this is all I can do. I can't pay what you're asking me to pay. I need to have a payment plan. They may not like it, but most cases they will do it because it's better to get some money than to get no money. Use the snowball method. Start with your lowest bill that you have it's like a credit card or a revolving payment or something like that. Pay that off and then use that money to go toward the next lowest bill, and snowball. It gets larger and larger as it rolls downhill, and you'll be paying off more and more debt. Use lower interest rate debt to pay off higher interest rate debt. If you can get a loan on your credit card or a cash advance, if you have a credit card, even though that might be 23% or more, that's still better than the 400% that we quoted to you earlier. So do that. Stop immediately doing any additional payday loans. It was just like the lady that I gave you as an example. She went from one payday loan establishment to the other. So she obviously had two. And I would hope that she didn't have any more that she was working on getting to try to pay off one of those two. So stop that immediately. Do these things and it will help. So pay off all your payday loans. Use your car title, high cost loans. Get a loan from a traditional bank or financial institution, a credit union, an online lender. We've given you some resources on that and some actual places you can go. Find additional sources of income. work some overtime, get a second job, do some gig opportunities. You may have some things you can sell those things and use that money to retire your debt. Here are some additional resources that you can use these to get more information on payday loans. Some of these are links that we've already given you and shown you how to use the tools, but feel free to use any of these. You can see everything from Nerd Wallet to Credit Karma. These are all legitimate sources, the consumerfinance.gov. So all these are legitimate. We know they're real. They're not trying to scam you. Our other budget in the box system presentations, we helped you set up an online budgeting system. We had the buy now, pay later, actions to take to prepare for a health or a financial crisis. You'll find those on our YouTube page. Please use those in any way that you can to help yourself or others that you come in contact with. That's what they're there for. If you have any additional questions, please feel free to contact me. I'm the Financial Literacy Manager at the Knoxville-Knox County Community Action Committee. There is my phone number and my email address. Contact me and I'll be more than happy to help you. We're glad that you were with us today. We thank you for listening to our presentation in the Budget in the Box series, and be looking for additional presentations as we're always working on something. So have a great day, and if we can help you, please let us know.